Hey everyone, thanks for tuning in. Chris and Jason here with the Private Lenders Podcast, sponsored by our mastermind group, hardmoneymastermind.com. Today we are going to be answering some questions from mastermind members. By the way, it's totally free to join. Anybody can go there, create a profile, join the conversation, see what people are talking about, check out some of our trainings anytime you want at hardmoneymastermind.com. Okay, so we're going to answer a few questions that we've been involved in an ongoing discussion about on a couple topics related to raising capital. So I find it interesting, and this is not a knock on anybody at all, but whenever we put something out there in terms of training related to hard money, it could be capital or underwriting or pricing, whatever it is, everyone always takes it and immediately remixes it. And again, there's not necessarily anything wrong with that. I'm curious about why that happens. It's totally normal for people to take something they learn and to, tailor it to their business, how they want it to run. But it seems like it happens across the board. I don't know. There's just kind of a random thought that when I was like taking notes for this podcast. What do you think about that?
I don't know. Keep flowing a little bit on it.
Okay.
Because I know it's like you've got a bunch of stuff built up in your head related to this topic. So keep flowing, and then I'll chime in.
Okay. Yeah, we'll circle back to that, underlying sort of principle. And again, there's nothing wrong with it. Not a knock on anybody. It's just super interesting to me as we're interacting with all of these new and experienced lenders in the mastermind group. So one that we wanted to chime in on is from Sean Magner, who is a real estate investor here in the DC, Baltimore area and wants to get into private lending as well. And he is toying with the idea of making a tiered sort of capital raising system based on, for example, the examples he used as I'm looking over at the other screen at the same time. If he is bringing on capital for, minimum of 100K, I like that. 100K to 200K initial investment with him for loans will earn you an 8% annual return, 200 to 300K, 9%, and 300K plus 10%. So a few things on this. One, when you're first starting out raising capital, this doesn't strike me as a bad idea. Granted, we don't do that, and both my comment and Jason's comments had to do with, we kind of just like keep it simple. We like to keep it simple, right? Like we lend at 13%, we pay our people 10. Pretty straightforward. So I do like the simplicity. I think that later on, so yeah, to answer that question a little bit more, I don't think it's a bad idea. It entices people to invest more so they can hit a higher rate of return. When you're initially raising capital, that's what you need. You need more. You need more funds. I do think that will get a little bit convoluted later on. I think that Sean will probably end up moving away from that setup later. Like some people grow by putting more in. Are you going to track exactly who gets what as that happens? Like, what if they they have 400K with you and and they're at the 10% range, and then they get a loan payoff and take it back. Are you going to drop them down to 9% for the next one? And then I could see it getting a little convoluted down the road, right? When you think?
Yeah, I mean, you got to be consistent. Consistency is huge with this. Simple's huge on this. I mean, our business model was based on very simple tactics. I would say, like, it was like, cool, we should just do it like this because why not? Like, we just kind of, when we came up with note rate -3, we're like, yeah, that seems to be fair. It comes out. And when we did that, it was, originally we were lending out at 15 and 5. So it was 12 and 15, which equates to 80-20, right?
80-20.
So we're like, yeah, that sounds about fair. 80% goes to them, 20% goes to us, plus we get all the fees. So it ended up that after like a certain amount of time the money was deployed, it ends up being that it's kind of split 50-50, right? And we're like, yeah, that's fair. Someone puts up all the money, with the points. So someone splits all the money. We do the heavy lifting, sweat equity. That's typically kind of the setup about 50-50. But I think however you do it, you want to make it consistent. Now, a few things to keep in mind. One of our first offices that we opened, or not, our second office that we opened, ours was obviously the first. We had a partner that was like, dude, I know people that will put up capital at 6%, 7%. Why don't we get cheaper capital in order to make more money? And that wasn't anything we were ever attracted to. And I'll tell you why. We realized that the capital investors and partnerships that we created with our investors, we wanted to be strategic Not necessarily meaning like additional opportunities, but we wanted the right influential people that understood the business model and were on our side with things, right? So that, let's say you raise capital for 6% from a passive investor, and they didn't fully understand the business model. Stuff potentially goes wrong. All of a sudden, they're like, "Wait a second, you told me this is a good deal." Then potentially you have a falling out and a disagreement, and we just felt like that could potentially trigger the wrong types of capital investors. And we wanted someone who would get a double-digit interest rate return, right? So back in the day, they're getting 12. Now that we lend out at 13, they're getting 10. It's still a healthy enough return with a sophisticated enough investor that we felt that our objectives were aligned together. So that's something to consider, right? Just because somebody has a lot of money and is willing to take a low interest rate for that money doesn't mean that they're a good strategic partner for you.
Yeah, I mean, you're getting into a long-term relationship with your capital investors, right? Like, this is not like a one and done sort of deal. They'll be out in 6 months or a year. That's not the way it works. I mean, if everything goes according to plan, they're going to be with you for decades. That's right. And also, when you hear stuff like that, like, "Oh yeah, I know this group, they're putting out money at 6, 7%, I always immediately think, like, how real is that? First of all, is that even real? Is that somebody just looking to broker a deal to something? I don't know. Are these people that you want to be in bed with for an extended period of time? Maybe yes, maybe no. But yeah, I mean, you have to vet and underwrite your capital investors just like you do borrowers.
That's right.
And there should be a very transparent, very partner type relationship in here. And something else we ran into, going back to like the interest rate that is being paid out to your investors, is I have heard people say, and we've even tossed around this idea many years ago, it's like, all right, just tell people that we're going to pay 10% and we'll lend out at whatever note rate we lend out at. Like, we're going to pay people 10%, maybe we'll lend at 12, maybe we'll lend at 13, maybe we'll lend at 14, which becomes problematic. It's not a bad idea, not a bad thought, but then you immediately realize that you're going to have to answer the question, well, when you lend out for more, why don't I get any more? And there's just no good answer to that. There's no answer besides like, well, I just wanted to keep a little more.
Yeah.
So I don't love that approach either. Like, going by the sheer numbers, like, no rate -3 seems to be pretty good. If you want to put it up as an 80-20, I think somewhere in there's a rate target, even if that comes out to be kind of a funky rate of return based on your note rate. 80-20 seems to be a good sweet spot. It really does. If it goes into default, it's more, right? Because then there's significantly more management of that loan. If it goes into default, okay to raise yours. Ours goes to 17 to them, 7 to us at a 24% default rate. But there's some initial thoughts on that.
I mean, we could make hundreds of thousands of dollars more a year just by lowering our return to our investors by a point or so. And, although that might sound attractive short term, that's not necessarily the right business model. You want the right people. When everything's going good, everything goes good. But when everything doesn't go good and you got to go foreclose on a borrower or you get sued by a borrower, the last thing you want is your capital investor to turn on you as well and say, you know what? I don't want to be in this investment anymore. Then what are you going to do? You're not going to find someone else to buy out an investment potentially that's not performing. So you got to be in it together as a team, and you got to think on both sides. If you have the capital, what type of investment and risk, reward, return are you looking for? Keep in mind, if there's any downfall of private lending, it's the way that our business model is taxed, right? It's interest income. Right? It's high, ordinary income. It's high. So what ends up happening is, if you're a high net worth individual, you might be getting taxed at, close to 50%. So a 10% ends up being 5%. If you're getting 6% from somebody, it might only be 3%. Like, doesn't make sense. Now, we've obviously done other videos in the past related to why, going after huge whales in this business isn't obviously the best demo to attract. They're looking for much higher returns, but at the same time, you're not just looking for anybody who's got $50,000 that wants to deploy into a deal as well. When I said the term strategic earlier, it was somebody who understands the business, understands you, are going to be collaborating with you during the good times and the bad. So it's just something to think about. And I think most people, even if you don't take our word for it, you're going to learn firsthand on it. It's very easy to learn this because, number one, if you put the wrong capital investor in place, first off, as soon as the deal starts going sideways, they're going to micromanage you every darn day of what's happening with this, what's happening with this, what's happening with this. Why don't we do this? Oh, I need my money back, right? You're going to drive yourself absolutely crazy. You cannot be involved in a loan that you're working on with a borrower that your capital investor is asking for status updates every day. It's just not a good thing for either one of you. So you're going to learn that either way, right?
Yeah,
so,
you're going to learn it from us, or you're going to learn it on your own. But either way, you're going to learn it. That's a very good point. Okay, cool. I want to jump over to another question from the mastermind group. I'm looking over the mastermind right now, and this a little bit more nuts and bolts kind of stuff from Tracy S. All right, so there's a couple parts to this related to documentation, attorneys, interest rate of return. So I want to touch on a few things here, and we'll post this in the mastermind too. I would like for Tracy to get this explanation because it was a little bit hard to answer all of these typing. I thought it'd be better for the podcast format. Okay, so the first question is, how do you document, or like how do you actually do the transaction related to the interest rate arbitrage or servicing fee, as we call it? So a couple things, like one, the blanket agreement that you do with your capital investors, ours is called the lending and servicing agreement. In essence, that describes, written by an attorney, of course, describes what we're responsible for in terms of servicing the loan and providing all the documentation. The investor is responsible for doing any underwriting that they feel makes them comfortable enough to fund this deal. It could be just the things we have in our file. If they want to do additional stuff, that's up to them, due diligence, whatever it may be. And if you wanted to, you could add in, if you wanted to have a straight blanket rate of return, like it's going to be 3% servicing fee on every loan, you could put that into that agreement. Or if you're going to have any kind of fluctuation in your note rate, in your servicing fees, stuff like that, you can just do it in email, loan to loan, in the email communication. So you have the blanket agreement in place, right? And then when you're communicating via email, sending the information to the loan underwriting docs, all the other info to the capital investor, you can document in there, hey, this is going to be a 13% note rate. We're going to have a 3% servicing fee, and your annual rate of return is 10. And that should be sufficient right there. Of course, run it by your attorney, make sure they're cool with that. But I don't think it needs to be a fancy document loan to loan, especially since you're going to end up doing a bunch of them, right? You're going to end up doing, maybe even every month, new loans with this investor, or a quarter, or a couple a year, whatever it may be. So keeping it simple, not racking up legal fees, not doing unnecessary paperwork seems like the right idea. One thing I wanted to touch on the couple kinds of attorneys, and we're going to talk about their loan doc question after this. You probably need two different attorneys for the things we're talking about. One is a business type attorney that does operating agreements, right? Maybe funds, stuff like that. Investor agreements in general would be the right person to do your blanket agreement. Ours is, again, it's called lending and servicing agreement with your capital investor. It's not necessarily, it could be, but not necessarily the same person who's going to do your loan docs. All right, let's talk about loan docs. So this is a pretty narrow niche in the legal world, right? If you think about just doing commercial loan document set as your entire legal practice, that sounds like it wouldn't even exist almost. Like that sounds like it's too narrow of a field, but it's not. There are attorneys that do specifically this, and you can find them. I mean, they're probably not everywhere. Like they're not title attorneys. They're not general real estate attorneys. They're definitely not like regular business attorneys. It's a pretty niche thing related to doc preparation, title review, everything else. And to answer Tracy's question, those people will understand perfectly the assignment part to the investors. You're assigning this note and this deed of trust and the loan documents to the investors from your company's name to the investors who have funded this loan. And that I also want to touch on another part of that question related to investing alongside your capital investors, which is of course a great idea. You don't have to. We didn't when we started, and then over time we most certainly have. Now that can be a one-off thing, like, oh, hey, on this loan, this guy's going to fund 100% of it. It's going to be a $200,000 loan. And then on another one, it's going to be, all right, it's a $100,000 loan. We're going to put up 20 along with you putting up 80,000. It can be one-off like that, just based on the funds that you have at hand, which typically is pretty common because you're going to have money going in and out. If you're co-lending with your people, you have loans paying off and loans funding all the time. So to have a blanket set amount, I like it in theory, but in practice, it's not going to be that simple. Like if you said, hey, I'm going to match, unless you have super deep pockets, it would be hard to say, hey, I'm going to match 20% of every loan amount. You put up 80%, I put up 20%. Sounds good. Not a bad idea. If you have the resources for that, could be fine. You could even put that in your lending and servicing agreement, right? If that were totally the case. Sure. But in most people's situations, it's not going to be that cut and dry every time.
And the right attorney for something like this, and I know a lot of people run more in the consumer world, like the residential home mortgage world. And that's just the wrong type of person. You need someone that understands commercial doc sets. Even though they might not have done loan docs for like a hard money lender before, they could for a commercial bank. It's very, very similar types of stuff, because for the most part, a lot of this stuff is very similar to a lot of these larger commercial transactions, right? A bank does a $15 million transaction. They might participate with another bank. They might participate with individual private investors. They might invest however they do it. And one of them's funding it. They might be assigning it to another party that's servicing it. It's what's not happening is it's not like a bank doing a deal and selling it off to Fannie Mae or something like that. That's homeowner stuff. That's consumer stuff. That's not the right type of person that you need. You need someone that understands commercial doc sets, business use transactions, and they're out there. And I'll tell you, there's a heck of a lot more of them out there now than there were when we got started. In general, mm-hmm. We were able to find someone who was an attorney who was lending capital themselves and understood the game a little bit. So, they were able to kind of put together a doc set for us. And then when we expanded into another market, and we hooked up with Harris, which we've done some videos with Harris. So if you look in the mastermind group, you'll be able to see that. He was working with a lot of other local commercial banks and things like that, and understood the process. And keep in mind, different attorneys have different viewpoints and different opinions, and doc sets vary. And one might not necessarily be better or worse than the other. And different states offer different things. Different jurisdictions offer different things. As crazy as it sounds, typically it's just the mortgage or the deed of trust, depending on what state you're in. And typically like the assignments of rents and leases that go on record. So a lot of these other things, a lot of your doc sets don't even go on record, but you got to make sure you put the right, the right docs in place that are going on record. Because if not, they're going to get kicked back anyways. So, they got to be the right font. They got to be the right size. So I don't necessarily want to state that you need somebody local, but you need somebody that understands the doc set that you're looking for. Because keep in mind, a lot of these bigger commercial banks that these attorneys represent, they're doing loans in lots of different states. They're not just doing stuff in their jurisdiction. So I don't think you need to have somebody that's 100% localized. I think just somebody that understands it.
Yeah, for sure. And was one more thing. I think we're probably about at our time frame now, but I'll just kind of drop this for something that we could discuss on the next podcast. So I got an email from someone on our big list, from our broadcast list in the mastermind group, who was asking me, to us, what does investor relations mean? Right? Like, what does that mean? From the upfront raising capital, which is more like a sales kind of process, to there's transactional stuff, there's relational stuff. And I think that'll make for a good podcast on its own. So stay tuned for that one. We'll cover that whole investor relations topic in detail, which has been an ongoing part of our business for 13, 14 years now. And yeah, anything else to mention while we're wrapping up here?
No, I think it's good. Any other questions, you want to continue this conversation, feel free to do so on hardmoneymastermind.com. If you're listening to this through iTunes and you liked what you heard, absolutely feel free to give us a review, comments. We'd appreciate it. Definitely, if you think anyone that you want to share this with, we'd appreciate it. This is the joke that you probably heard, is that if Chris and myself are not talking on camera or doing this through our podcast. We're just going to be at the office chatting with each other about it anyways. So we might as well spread our knowledge, with everybody through the podcast. And again, go check out the mastermind, hardmoneymastermind.com. It's completely free. There are obviously kind of upgrades and things like that if you're interested and you want to kind of expand. But the majority of the stuff inside there is free, and there's a lot of good chatter and discussion. And we're actually might even open up a way to share leads and capital and things like that here in the near future. We're trying to figure out logistically how to do that. So we will all touch base soon.